Okay, let's unpack this.
Let's do it.
We are diving deep into the recent Q3 2025 earnings call Q&A session. And this wasn't, just a standard update.
No, not at all. It felt much more like a rapid-fire grilling, really. You had institutional analysts, retail shareholders, even media, all pushing management on their biggest bets, their most ambitious growth plans.
And the timing, as you pointed out before we started, that's really crucial context for you listening.
Definitely. It all happened right as they were handing over the reins from the retiring CFO to the new one.
So a backdrop of change and continuity.
Exactly, which meant every single answer about future growth, about financial discipline, it was under this intense spotlight. They needed vision, yes, but also concrete numbers.
That pressure really seemed to shape the whole conversation. It felt like it focused very tightly on maybe three main areas.
I'd agree. First, pushing product velocity in their core stuff banking trading tools.
Right. Then second, their big bets on the, let's call it, strategic frontier, tokenization, prediction markets, private markets access.
And third, that long-term vision, the super app idea and their global footprint.
It really was all about execution, wasn't it?
Absolutely. So, okay, let's start where they started. Accelerating those core products and, crucially, making sure the platform itself is solid. Resilience, that's table stakes in this business.
Yeah, you can't afford downtime.
Yeah.
So Robinhood banking, that was front and center. Management sounded, well, really confident about how fast they can roll this out. Relatively fast rollout was the phrase, I think.
They did.
Now, banking usually sounds complicated. Regulatory hurdles, tech integration. Why were they so sure about the speed here?
Well, they were quite specific. It comes down to the complexity of the product itself.
Okay.
They basically said, look, this banking product in its current form is just simpler, especially compared to something like launching their credit card.
Ah, okay. The credit card needed much more complex stuff. Risk models, economics.
Precisely. Far more intricate calibration needed there. So because this core banking offering is simpler, the speed feels more about iterating based on user feedback, not untangling really complex financial plumbing right out of the gate.
And they highlighted some of that early feedback too, didn't they? Sounded positive.
Yeah, they did. Customers seem to be engaging. They specifically mentioned people liking the interest they earn on checking balances.
Which is a big differentiator these days.
It is. And also the convenience, apparently, of instant cash delivery in some big markets. They mentioned New York, for example.
Okay, so features designed to reduce friction.
Absolutely. It's all about minimizing friction, maximizing the utility. If you can earn decent interest on your cash and they handle your basic payment needs, well, it's a pretty clear path they're trying to build.
Towards making Robinhood the primary account, right? Where you deposit your paycheck, not just the app you check for stocks.
That's the end game. That's how you get sticky revenue, keep the money inside the ecosystem.
Now, talking about operational stuff, they also had to address platform resilience. There was that AWS issue recently that hit a lot of the internet.
Right, the unavoidable question.
Yeah. It caused degradation on their platform, too. So how did they handle that question? Did they maybe use the crisis to make a point about their own improvements?
I think that's a fair way to put it. Yes, the service was degraded. That's the key word they used, meaning lots of customers probably experienced a slower app, maybe some delays.
But not a full crash.
Exactly. And that was their main takeaway, framed as a major operational win, actually. They pointed to all the past investments they'd made in infrastructure, in resilience.
So the argument is, years ago, that same AWS outage might have taken them completely offline.
That's what they implied. But because of those investments, the app stayed up, maybe sluggish, but up.
So customers could still manage risk, place orders, even if it wasn't ideal?
Precisely. They're essentially saying, look, we spent the money on redundancy, and it just paid off in a real-world stress test. Even during a massive external event, users had some control. That means a lot to active traders.
And that focus on continuous improvement, it links directly to the next big thing they discussed, product velocity. That phrase, incredibly inspirational change in product execution pace. What's behind that speed?
Yeah, they got asked that directly. Management pointed to, I think, three main things.
Okay.
One was just building a stronger foundation after all the, post-COVID craziness, getting the basics really solid.
Makes sense.
The second, and this seemed key for decision-making speed, was adopting the general manager model, the GM model.
Right. break things down into smaller units.
Exactly. For you listeners, think of it like mini CEOs for each core area. Banking gets a GM, crypto gets a GM. They own the product, the P&L, the whole 9 yards for their unit.
So decisions happen faster. Less climbing the central corporate ladder for every little thing.
That's the idea. It empowers those GMs to move quickly. So you combine that model with the solid foundation and the third piece they mentioned, strong alignment across all teams on financial guardrails. Basically, making sure everyone's on the same page about ROI for new projects.
Fast, but fiscally responsible.
Supposedly, yes. But there was one other piece, often overlooked when we talk about speed, the underlying tech.
You mean AI? They mentioned that.
Yes. They were clear, they're not building the next ChatGPT themselves. They're not a foundation model company.
Right.
But they were an early adopter of using AI internally, driving efficiency.
Where specifically?
They mentioned customer service workflows getting a big boost and also engineering practices. So AI is like this hidden engine giving them leverage and speed that maybe older financial firms don't have as readily.
That's a great segue, actually, into the second big area, the trading engine, prediction markets, crypto, where the new revenue streams are really kicking in.
Yeah, prediction markets, what a success story that's been for them. Volumes just taking off.
But the question is, how do they keep that lead? You see new competitors popping up trying to grab a piece of that pie.
Their answer was pretty direct. It boils down to distribution and infrastructure.
Distribution meaning just the sheer number of users they have.
Pretty much. You got to remember, over 26 million funded accounts. That's a massive, massive head start. New niche platforms, they just can't replicate that kind of reach overnight.
And the infrastructure part, is that about how it all connects?
Exactly. Their platform is built to be multi-asset from the ground up. Prediction markets aren't separate. They live right alongside crypto, options, stocks, futures.
So if I'm an active user, I don't need to jump to a different app to trade, say, an election outcome versus Apple stock.
Correct. Seamless integration. And their view on the market structure is interesting, too. They think prediction markets will probably end up looking a lot like equities or options markets over time.
Meaning lots of exchanges competing.
Yeah, lots of exchanges, probably competing hard on costs, on fees. But in that world, the player with the biggest distribution network and the best integrated tech, they hold the real power.
And the data suggests that's working. New customers coming just for PMs.
They said so. They mentioned adoption is largely from existing active traders, which makes sense, but also new customers signing up specifically for prediction markets. And they've rapidly expanded the offerings, over 1,000 live contracts now, so the variety is there too.
Okay, shifting gears slightly within trading crypto. They give some interesting metrics there. Smart exchange routing changes seemed important.
Very important. And the volumes are significant. They exited Q3 with, get this, $1 billion in crypto staking volume.
Wow. Okay, $1 billion staked.
Yeah.
But let's talk about the take rate. That's always a hot topic with crypto brokers. They said the blended rate is holding in the high $0.60 zone. Can you just quickly break that down for listeners? What does high $0.60 zone actually mean?
Sure. It basically means for every $1,000 worth of crypto traded, they're generating on average somewhere just under 70 cents in revenue. That's the effective take rate.
Okay. And the fact it's holding steady or improving, that suggests their smart routing is working. Balancing good prices for users with generating revenue.
That's the implication, yes. The system seems optimized, but here's where, as you said, it gets really interesting.
It's a personalized pricing aspect.
Exactly. They frame this smart exchange routing as basically step one towards personalized pricing, and they're specifically using it to target a group they call prosumer traders.
Prosumer. Okay, define that for us. Not quite retail, not quite institutional.
That's it. They sit in the middle. Think high-frequency, high-volume individual traders, people who are very sensitive to the price they get, the execution quality.
Right.
So this new routing option lets these prosumers choose a specific execution path that offers them potentially better pricing guarantees.
So it's not one size fits all anymore. They're tailoring the experience for their most valuable active traders.
Correct. And the key proof point they offered is that when these prosumers choose this option, they actually bring more trading volume to Robinhood overall.
So it validates the strategy. Attract the high-value users with better service, and they trade more with you.
It's classic market segmentation using tech. Increase the lifetime value of your best accounts.
And related to trading tools, they briefly mentioned shorting. That was announced at their summit. Any updates on the rollout?
Just a clarification, really. They made it clear that shorting is not available to external customers yet.
Oh, okay. Still internal testing.
Yeah, employees only for now. So its actual impact on things like margin usage, overall risk profile, that's still unknown territory for the public platform.
Got it. Okay, let's pivot then to the bigger picture, the long-term vision. Section 3, the super app and the global ecosystem.
And Robinhood Banking is really the foundation here, isn't it? The goal they stated, get customers to deposit their paychecks directly.
They get the primary vault.
Exactly. Minimize any reason for money to leave the ecosystem.
But the really ambitious play, the multi-decade strategy they talked about, is tying into that massive generational wealth transfer, the $100+ trillion opportunity.
Yeah, that's huge. And their angle is interesting. It's not just about individual accounts. They're designing the product explicitly as a family product.
What does that mean in practice?
Creating a really good user experience, not just for the primary account holder, but for their partner, for their kids, maybe even household staff down the line. They specifically mentioned plans for trust accounts, custodial accounts, features that serve the whole household.
And they believe this gives them an edge.
That's their conviction. They think they're uniquely positioned to grab an outsized share of that wealth transfer precisely because they're designing for the entire family unit. An approach they argue the legacy players just aren't focusing on in the same way.
So it's a long game, not about next quarter's results, but building relationships over decades.
Definitely a long-term investment thesis. And tied into that domestic vision is how they're thinking about private markets. They called it the biggest inequity in finance today.
Which is?
The fact that these exciting private companies, especially in AI and tech, are staying private for much longer, hitting massive valuations before they ever go public.
Right, so most everyday retail investors miss out on that early growth phase.
Exactly, they're locked out. So Robinhood Ventures is their answer to that. They said they surveyed users, and the big demands were access to concentrated private portfolios, daily liquidity if possible, and, crucially,
Not needing to be an accredited investor.
that's the one. Because that rule excludes something like 85% of Americans from participating in private deals.
Wow, 85%.
Yeah. So Robinhood Ventures, their first fund, is specifically being designed to allow non-accredited investors in. They mentioned the SEC filing for that is already underway.
Okay, that's a big move domestically. What about the global picture? Their ambitions seemed huge there, too.
It is. The goal they stated is aiming for over half of their total revenue to come from outside the U.S. within the next 10 years or so.
Half their revenue internationally? How?
It's a mix. Part organic growth, they pointed to progress they're making launching in the UK, for instance, and part strategic M&A, mergers and acquisitions.
And Bitstamp fits into that M&A piece.
Bitstamp is the cornerstone, really. It's their first big institutional-grade business acquisition. And the early results look promising. They said volumes on Bitstamp were up over 60% quarter over quarter since they took over.
And Bitstamp isn't just about crypto trading volume, right? It plays a bigger role.
A much bigger role. It's key infrastructure for their tokenization plans, which brings us neatly to that final frontier they discussed.
Section 4, tokenization. This feels like potentially the most disruptive piece of the strategy.
Right.
They laid out 3 phases for tokenized equities.
Yeah, a clear roadmap. Phase 1 is what's happening now.
Which is,
Ramping up the selection of tokenized foreign stocks available on the platform. They said they have over 400 now, making them one of the largest providers already.
and how do they make money on that?
There's a foreign exchange fee, 10 basis points, they said.
Okay, hold on. 10 basis points. Let's translate that quickly. That's 0.10%, right? A tenth of a percent.
Correct. 0.10% of the transaction value. So a pretty low fee to get access to global stocks fractionally, 247, makes Phase 1 very accessible.
Okay, that's phase 1. What's phase 2?
Phase 2 leverages Bitstamp. The idea is to enable secondary trading of these tokens on Bitstamp.
Ah, so moving beyond just buying them initially.
Yeah.
Creating a real market for them, building liquidity.
Exactly. It builds the necessary liquidity infrastructure.
And then phase 3, that's the big one, the very, very disruptive goal.
That's the ultimate aim, taking these tokenized assets onto DeFi, decentralized finance.
Okay, why is that the game changer?
Because being truly on DeFi opens the door to things like self-custody. You actually hold the tokenized asset yourself, and then collateralize lending and borrowing directly against those assets.
So imagine using my tokenized share of Apple that I hold myself as collateral for a loan without needing a traditional bank in the middle.
That's the vision. It fundamentally changes how securities markets could operate, cuts out intermediaries,
Now, they must have gotten questions about the challenges, right? Like
Yeah.
different blockchains, liquidity getting fragmented everywhere.
Oh, yeah, they addressed that head on. They acknowledge that right now, these tokens are kind of a walled garden. They're backed by real trades, but they don't live on public DeFi chains yet.
So how do they see that evolving?
Their view is pretty optimistic, actually. They expect interoperability between blockchains will just naturally get better over time. Community projects will build bridges, wrappers,
Yeah.
ways to move assets between chains.
And the fragmentation of liquidity, trading happening on different venues.
They basically said, look, managing liquidity across different trading venues is what market makers do. It's a standard problem, maybe even easier to manage with crypto's underlying tech compared to legacy systems with all their silos and integration costs.
Interesting perspective. And this tokenization vision, it wasn't just about stocks, was it?
No, much broader. The real excitement, perhaps, is applying this blockchain tech to bridge TradFi and crypto for massive, traditionally illiquid asset classes.
Like what?
Think real estate,
Mm-hmm.
private credit, even collectibles, fine art, things that are huge markets but hard to trade quickly or in small pieces.
So tokenize a building or a piece of art, and suddenly you could trade 247 in tiny fractions.
That's the potential, shattering that historical liquidity lock-in, unlocking potentially trillions in capital that's currently tied up for long periods.
Okay, one last thing from the Q&A. They touched on something a bit philosophical. The internal debate about putting Bitcoin or other digital assets on their own corporate balance sheet.
Yeah, that came up, following the path of a few other public tech companies.
Right. It raises that interesting question.
Yeah.
How do you balance aligning with the crypto community versus, strict financial prudence with company cash?
And they were open about it being an active debate internally, weighing the pros, which are mostly about community alignment, sending a signal against the cons.
Then the cons being.
Well, using working capital on volatile assets is the big one, plus the redundancy argument. Shareholders who want Bitcoin exposure can already just buy it directly on the Robinhood platform anyway. Why should the company do it for them with corporate funds?
So it shows they're thinking hard about that balancing act. Strategic messaging versus disciplined capital allocation.
Exactly. It's not a simple decision.
Okay. So wrapping this all up, what does this Q&A really tell us? What's the main takeaway for you listening?
For me, it confirms this really singular, aggressive strategic theme. They are absolutely leveraging their core strength, that massive distribution, the 26 million accounts, to push hard into these new, complex, high-speed areas. Prediction markets, private ventures, tokenization.
While at the same time, making sure the foundation is solid, right? Yeah. Shoring up infrastructure, proving resilience.
Yes, and playing that long game with the family account concept to capture the generational wealth transfer. It's all about speed, scale, and integration. Those seem to be the mantras.
The ultimate theme feels like breaking down old walls,
Yeah,
dissolving traditional boundaries.
I think that's right, especially with tokenization.
So let's leave you with this final thought then. Focus back on that Phase 3 tokenization vision. Self-custody, collateralized borrowing and lending, using tokenized assets you directly control.
Mm-hmm.
If they actually pull that off, if individuals can truly use digital assets, they hold themselves as collateral, bypassing traditional lenders, well, the line between traditional finance and decentralized finance basically vanishes. Securities become almost like 247 liquid commodities. So the provocative question is, if that Phase 3 becomes reality, what long-held pillars of today's financial system may be the central role of custodians, or how secure lending works, what's the first pillar to really start crumbling?
That is something to mull over. What falls first when assets become truly digital and self-sovereign?